All right, all right. Good evening, everybody. Welcome to this live stream on this Sunday evening. Hope you guys have had an amazing week. Obviously, we've had the spring statement, which I gave a little bit of commentary on Friday. I think there was a sense of maybe a little bit of disappointment, and I ran a poll on Instagram, which was actually quite revealing on Saturday as a result. And yeah, the disappointment I think is palpable when it comes to the spring statement specifically. But anyway, for this live stream this evening, I'm going to be joined by the CEO of Wealthify, Andy Russell. GG Playboy, I can see that you're here. Naeem has already put in a question. As you normally do, you get here early and you leave questions already. So we'll get through all of the questions as we kick on. But what I thought we'd do basically is we're going to have a chat with Andy and kind of have a little talk about kind of the world as it is currently at the moment, cost of living, those kind of things. Maybe get a little bit of an insight from Wealthify's point of view in terms of how they see the world and what they're doing in this space currently. Because I think it's always nice to have insights beyond my own around the world of investments. And hopefully you guys can take something away from this stream as well. As always, I will be open to questions. Both of us will. So if you do have questions, then obviously feel free to pop them in the chat as well. As far as I can tell, everyone can hear me clearly, can hear me nicely. If not, Pete, how you doing? GT Playboy. I'm going to bring in Andy now, and we're just going to kick off and have a little bit of a conversation. If you do have questions, like I said, especially if you are already using Wealthify, then this is the chance to basically ask the boss who kind of is behind the business here in the UK questions that you may want to ask someone of his stature. So I'm going to bring in Andy right now. Good evening. Good evening.
Hi, Pete. Good
How
evening.
are you?
Not
Are
bad,
you
thanks.
well?
Yeah, not bad, you?
I'm not bad. I'm not bad at all. I'm not bad at all. Thanks for joining us on a Sunday evening at like 8 p.m.,
It's all right.
especially at Mother's Day as well.
Well, indeed. Indeed. It's good to get away from the kids once in a while on a weekend, isn't it?
Yeah. What has your weekend been like so far?
Taxiing, fitting in exercise where I can, and then trying to make up for makeup presents for the kids didn't buy my wife for Mother's Day. So, how about yourself?
It's been pretty much work. Pretty
Oh,
much.
no.
Yeah, I'm behind on a load of stuff because obviously I've been doing a load of other work for Channel 4 and stuff. So things
Yeah,
like my magazine, I concluded that today. So I've got to release that at some point later on tonight, get the email out so it's sat in people's inboxes for tomorrow.
cool.
So we're going to do that this evening, but it's been pretty much work through the weekend as I normally do, essentially. So, but yeah, so I thought it would be great to have you on because obviously you guys are supporting the channel for this part of this first part of the year, and obviously I talk a lot about investing here and market topics, stuff that through the pandemic has been very, very popular. There's been a lot of traction, a lot of new investors. So I thought it would be interesting to have you on as the person who's behind kind of Wealthify, kind of to pick your brains on what you think of the landscape right now and just get your general thoughts around what you guys are really, what your goal in the marketplace is and how you're here to potentially help people. And hopefully the people who are watching will also have questions for you. But to start off with, can you just give a little bit of an introduction to you?
Yeah. So, I think you probably introduced me already, Andy Russell. I'm the CEO of Wealthify. I think you're probably more interested in Wealthify than me. Wealthify is what's commonly known in the UK as a robo-advisor, which is basically an Americanism for a digital investment manager. We manage people's investments for them in a really simple, diversified and digital way. We make it as easy as possible and simple as possible for people to invest. And we do that from as little as £1.
Okay. I know your work quite a bit because when I started this channel in 2020, I first started off doing a round of reviews. So you were one of the first companies that I reviewed.
Yeah.
And back then, I really, really liked the fact that I looked at it as though, right, so I've been in the industry for quite some time. And I thought, if you're a first time investor, just starting out, coming across, investing as a theory, how would you go about using the provider and making sure that you're in a position where you're not constantly second guessing yourself. And what I found from you guys was that you guys presented information really, really simply on the website. And subsequently, when I had my investment call, which I still have, you guys, after I explained, attitude to risk and timeline and all asset allocation, how all of that works, and the various ways in which you can invest. So you can go and pick stocks on your own, or you can just outsource it to someone like yourself. I chose you guys as kind of like the best place for someone to start because you made the information easy to understand. There wasn't any jargon. It's very, very simple to understand. And I felt that you put people in the best position so that they weren't going to second guess themselves. I guess for you, was that always kind of like an intentional thing? Because there's a lot of jargon out here and it does confuse people.
Yeah, completely. So it's unsurprising that we say where people can invest from us from as little as £1, and then our proposition is one that speaks simplistically, accessibly, and jargon free. I know it might be cheesy to kind of quote a company purpose, but the guys in Cardiff, they're a great bunch. They're a very purpose driven bunch, and we kind of created a purpose ourselves. We are here to inspire anyone to build their future wealth. And that anyone is really important for us. The majority of our people in our company, I haven't got a heritage with lots of money in the background or lots of people to help with the knowledge of what to do with your money if you're lucky enough to accumulate it. So the company was founded. The core founders built it to help people who don't know or didn't know how to invest or didn't have the time or the confidence to invest. And we built the proposition around that. So we built it so that anybody can access it, that you can go through the customer journey. It's a beautiful customer journey, actually. The dev guys that we've got have built a brilliant customer route through a really simple way to navigate. The language we use is simple. The design of the pages are really nice as well. They've done a great job of that. And then we back that up by saying you can invest from as little as £1. You still have to pass the right suitability requirements that are required by the regulator. So an investment product has to be right for you. But that is where we're aiming. We're aiming to try and bring as many savers into the world of investments as we possibly can. There's about £300 billion of money in the UK that's sat in savings accounts for the long term for 5-10 years, earning 0.05%. Very little amounts every year. Year after year after year, and that's the rich are getting richer, and the people that are sat in the savings accounts are getting comparatively poorer, and that's really going to kick home in the next year or two when inflation's kind of peaking near 10%. That's just going to eat away at your savings accounts. So our proposition, short answer is yes, our proposition is aimed at people who want to access investments in a simple and accessible way.
You've made some really good points there around moving savers into the investing kind of like sphere.
Yeah.
Because this is my opinion anyway, and I'd love to hear yours. My opinion is that it's always been quite difficult or complicated to begin investing, particularly if you know nothing about it. You're not from kind of like the households where you would have those kind of conversations around the dinner table.
Yeah.
Making that jump is huge. And I think making it possible with, £1 so people can test the waters and get started simply is a big thing. But with inflation now, I wonder what your thoughts are around, do you think it's 100% one of those things that it's almost a situation where people need to seriously consider investing because the inflation rates are so high?
Yeah, I mean, there's a few factors you need to consider in there. So we always recommend that people have a rainy day fund of 3 to 6 months first, and then you need to look at when you need your cash. And if you need that cash again in the next 6 to 12 months, then you're at risk of hitting that volatility.
Mm-hmm.
That aside, if you're keeping your money for 3, 5, 10 years plus, then you should be looking at how you get the best return from that, how you make that as big as possible in the future. And inflation is going to is definitely, you are guaranteed that inflation is going to eat that away at you if it's in a bank account. Now
Mm.
you do get the ups and downs with a stock with the stocks and shares based products. That's its nature. It's not a guaranteed amount, but through the long term, and this is why we kind of talk around investments for the longer term, not for the 6 or the 12 months. Through the longer term, you kind of look through and you invest through the ups and the downs, and the ups generally, if you invest for long enough, beat inflation. So as long as you are investing for the longer term, then you should seriously be considering investing if you haven't before, because it's, particularly over the last 5 or 10 years since the financial crisis, we've never seen inflation as high as this.
Yeah, I mean, it feels like it's a completely different territory right now. I mean,
Completely. Yeah, yeah.
inflation numbers, we're at 40-year, 30-year, 40-year highs. Well, so I
Yeah,
think in the US it's like 40-year highs.
yeah,
Over here it's like 30-year highs. So trying to have a look at, and I think this is the biggest challenge that most people face. It's how do they make their money go a little bit further,
yeah,
but understanding that actually there's still a little bit of education that needs to be undertaken in order to make sure that they're making the right decision to actually invest in the markets in the first place.
yeah.
How important do you think education is in that decision making tree of I'm in savings right now, I want to invest because everybody is saying we should invest and it's a big popular topic. What do you think?
I, for me, I mean, there's lots of reasons why people don't invest, but for me, the biggest one is education. And it might seem a bit of a cheat way to say, well, people aren't investing at the moment because of education, but we don't get taught it in school. We don't get we don't get taught about budgeting anymore. We don't get taught about stocks and shares versus savings. Um, there's lots of stats out there around people who don't really understand the calculation engine of a compound interest versus a simple savings account. So there's lots of base level information that will just help people understand to make an informed choice, and that's what we should be aiming for to make an informed choice. You do need to have that education. I think simplistic platforms like Wealthify, to be honest, all the robos offer kind of a really good simplistic solution. Start putting that power back in the consumer. It's so simple; it allows people access into something that they've not done before. But lots of people, I'm from a working class background in Yorkshire and Sheffield. Lots of people just aren't used to investing, and it's really hard to get them over that line to invest. They know what they know, and they know what their mates and their friends and their family have told them, which is put it in your bank, save for a rainy day. Even the name save, you put it in your
Yeah,
savings account. The word save kind of links you to it as well. But as I said earlier on, it's assuming you've got your rainy day fund and you're investing for the longer term, then whilst you may not know what the ups and downs are going to do in the next 2 or 3 years, you definitely know that your money is going to get eaten away by inflation in a bank account.
yeah,
So there's lots more we need to do around education. We're not going to change. We're not going to help all the savers that need to come across to investments in the next 6 to 12 months. It's going to be a longer term strategy. But that's what we're aiming to do at Wealthify. We've positioned ourselves to be accessible from as little as £1. We've got some great content on our website as well. Lots of blogs to help people understand how they should invest, why they should invest, what we do, all written in that very simplistic kind of language that we use throughout our web journey. There's some great tools on there as well, little saving calculators, pension calculators. In fact, the journey, the customer journey we put on our build a plan page, has got a great tool where you can kind of play around with how much you save, and you kind of see this generator at the right that says, well, in 10 years it could be this, or it could be, if stock markets outperform, it kind of going to do this, and if they underperform, it does this. And actually just being able to see that future pot size is a massive educational tool on itself. You just don't think how much 20 quid a month can make a difference to your life in 10 years time. So we need to do lots more on tooling and education. We need to do lots more on tooling, a lot more on education. We probably need to do a lot more as an industry as well. But we've started. The robos are out there now. We're starting to make a difference for the people who don't have enough of a pot size to kind of get taken on by an IFA. And now we just need to get the message out to as many people as can who are kind of saving for the long term and are at risk of getting eaten away by inflation.
I think it's a really good point you made about the IFAs there, because I think the barriers to entry, like there's in that realm, they're still very much there. I mean, they have certain limits that they obviously, because they're running a business, and I can understand the compliance costs and licensing costs and all that kind of stuff. But I think putting the power back in people's hands to be able to say, actually, there's a very easy way for you to go about starting to invest is really, really important. Do you think, because when I, obviously with the videos that I make here and the people that interact with this channel, and I guess across all social media, there is, I guess there are two camps of investors. There are kind of like the DIY camp
Yeah.
that, for predominantly, the big thing for them is they've got control, so they're able to reduce the cost and the fees.
Yeah.
Then you've got everybody else where, maybe education and understanding and knowledge maybe is a bit of a stopgap or a hindrance to them where they don't quite have the confidence. Who would you say that you're kind of best suited to in those situations?
So we kind of see it as a spectrum, and I'm adding the third on the right, which is the IFA,
Hmm.
the people, the customers who are better off with IFAs. So kind of coming out the back of the financial crisis, you had interest rates as a record low, people wanting to get more from their savings, and their choices were either IFAs or self-select. And from kind of your history, you and we work with IFAs as well. We're not in competition with the IFAs. We're looking at the smaller pot sizes. The IFAs generally have to be 75 grand, 100 grand or
Yeah.
more
Yeah.
because they've got lots of clients and they need to do work to generate enough fees to cover that cost. So
Hmm.
we're in a different consumer base to where the IFA where the IFAs are looking, and we link in with the IFAs for that reason. On the left hand side, then you've got kind of your self selectors, and that's for people who have the knowledge, so they know where to invest. They have the experience. They've invested in the past, and they know what to watch out for, where to get the information from, and they've got the time, so they can regularly monitor it. They don't just do the research, which is quite time consuming, to know which geographies to invest in, which funds are performing the best in that geography, but then also have the confidence to back that as well. That if you've got the time and your confidence and your experience to self-select, then you can get really cheap fees at the fund providers for 10, 20, 25 bips, and you create your own portfolio. But then you should be regularly monitoring it, because you've seen what's happened. We've had a relatively calm patch for the last 5 or 10 years, but comparative to the last 3. But you can see how quickly it swings in the last 3. And if you're not on top of it, your asset strategy, your investment strategy just gone completely against you. And so you need to be regularly monitoring it. You don't just need the experience, you need to be regularly monitoring it. And that 10, 20 bips difference, or 20, 30 bips difference suddenly gets lost overnight because you haven't been monitoring it regularly. But that's a different product to us. We're not a self-selection fund. We are a managed for you provider. So you've got kind of self-selection funds here, IFAs on the right, and in the middle is us, Robo's Wealthify, which is a managed for you solution. If you're looking for somebody to set you up a diversified portfolio that has kind of professional investment managers regularly managing and monitoring it and rebalancing the portfolios, then we're for you.
Yeah. How important do you think cost is in the equation when people are selecting sort of providers? Because that's one of the biggest things that I think is a leading argument for people who maybe want to start investing in the markets for the first time, and maybe they're looking at investing small amounts of money. The narrative is that if you're able to reduce and keep the cost low, you're able to keep more of your money.
Yeah.
Do you think that is a deciding factor and should be a deciding factor for first-time investors looking at investing for the first time?
Yeah. Short answer is yes. I guess the longer answer to that is the majority of funds in the UK are passive funds. That means you put it in there, the investment strategy is set, and it stays in there.
Mm-hmm.
And then you've got some people that kind of put those funds together and keep a watch on them. But generally, most funds that have a similar amount of equity to bonds compared to each other generally track in the same direction.
Mm-hmm.
You'll get some slight underperformers, you get some underperformers, but most funds generally track the benchmark, kind of a collaborative benchmark that everybody looks at for those different types of equity bond proportions. Because everyone's investing in kind of similar spread. if you're looking for different investment strategies, you're going like heavily into the US, then obviously you'll track away from the benchmark. But if you're looking for a generally kind of globally diversified fund, most people are tracking the benchmarks with different equity risk profiles. So once you kind of accept that that's a given, that you get a little bit of under overperformance around the benchmark, actually the biggest thing then is fees, it's costs. And that's really, it kind of links back into the education piece. It's really hard for people to kind of get to grips with when they're coming from a bank account that doesn't pay fees. They pay an interest rate, which is a lot easier to calculate or think about, and doesn't compound. So actually getting people to talk about fees, our savings calculator looks at how fees differ and tries to give people a feel of how fees differ to interest rates, how one fees differ to different other fees as well. But that's really important. If you're looking at, say, a 2% fee versus a 50 bips fee, what 1.5% difference per annum,
Quite a lot.
which is a lot, but that's not uncommon either. There's quite a lot of difference in the fees that people are charging at the moment. Over like 10, 15 years, you could be looking at like 20, 30% of your value growth difference. Now, you're not going to get that amount of difference in investment performance around a benchmark. They're all going to roughly track. You might get a little bit above, you might get a little bit below, but 20, 30% difference is driven by fees, is the biggest driving factor there. So you need to be on top of your fees. That's the biggest thing. Look at what you're being charged and make sure you're getting what you believe you're getting. You're getting value for money. If you go into a supermarket, you're buying a slice of bread, a loaf of bread, you look at which bread you want to get. You're getting your Warburtons or you're getting your Tesco values. You understand what the price versus quality or kind of flavor that you're getting. That's exactly the same you should be getting in the financial service products. Look at how much you're paying and look at what service you're getting. If you're getting charged 2% and you're getting a brilliant service and they're regularly managing your portfolio and they're outperforming investments, then brilliant, you crack on with that. But you have to be sure you're getting that. You have to understand what value and what service you're getting for your fees. And then you compare them and you contrast them. And the more tools we can get to compare and contrast, the better.
Yeah, I think that the challenge that most people face, especially when they're starting out, is they're not really too sure how they can actually go about comparing because there isn't kind of like that prior experience to go by. We always talk about the fact that past performance is no indication to future performance. But I always say it's always nice to kind of have a look at maybe a little bit of track record just to see how effective has the management solution actually been versus other areas that you've had within there as well. And I think that's going to be particularly important now, given the fact that, with inflation being so high, money in a savings account effectively is going to be eroded. For those long-term goals, it's going to be really important for people to, look at alternatives than just a simple savings account.
Yeah, I agree. And we've got a savings calculator tool on our website just for that. You put in your interest rate on your savings that you get in, and then it compares what you get. And in fact, shall I share it on screen actually?
Yeah. If you can, yeah. It should do.
Savings calculator, there we go. I'm gonna let me just have a quick look. Share my screen. Screen one. Right. Can you see my screen?
Let's have a look. Yep, I can. There we go.
Yeah. So there we go. This is just one of the tools. If you click into our products and then go into savings on our website, these are all tools that we try and give free of charge. You don't have to put in your web page or email address or anything like that beforehand to try and get as much information as possible. So say you've got £5,000, you're investing for 15 years, and you're earning next to nothing on your savings account. This is what you get at the end of your 12 years from a savings account. 37 quid more than you originally got. As I said, not very much. And this is what you get in our cautious investment portfolio. And then we've got different portfolios. So these is one of 5 risk profiles. So cautious is largely bonds and adventurous is largely equities. And then you can see the difference changes between the two. And then we've got our original product, which is whole of market funds, an ethical, which is it's an exclusion-based fund. We look at active funds there, but exclude weapons, adult entertainment, gambling, and tobacco. Most of our customers generally pick something like confident or ambitious. So you can see, I mean, these are they're not sales numbers. These are numbers taken from economic scenario generators from some of the market service providers that are, looking at, and I'm looking 15 years. I'm not looking at like 1-2 years. This is long-term investments. It's a massive difference you can make just by investing, and then you put in a little bit per month as well, and all of a sudden, where's that gone? All of a sudden, it makes a huge difference to what you're investing in, to the returns you get.
Because I guess that's going to be that will be compounding the returns as well, based on the assumptions that you have within the portfolio selections, right?
Correct. Yeah, they both compound. The calculations are that you leave your money in the savings account and you leave your money in the stocks and shares accounts. But these stocks and shares are invested in equities that over a longer time period outperform inflation. The downside of that is that there are ups and downs in the interim that you have to invest through. So if you're investing for shorter periods, this isn't for you. But if you're looking to invest in the long term, then you should be seriously considering these types of things.
Yeah, there was a question that I had here, which was actually from Naim. He posted this in before we started the stream. I'm just going to see if I can find it, because he actually asked around the ethical side of what you've got in terms of your investments here. So he said, "Hi both, hope you're well. I'm already investing with Wealthify due to the simplicity. I'm involved in your ESG funds." He's saying, he goes, What are your thoughts on ESG funds and coping well in the future to outperform non-ESG funds? I think that's a bit of a loaded question, to be fair, but I'd love to hear your thoughts on the ethical side of things. You just mentioned there that you've got screening against armaments, that kind of stuff. How important do you think that is within the investment world and the investment sphere?
It's getting a hell of a lot more important, and I think with some of the things that we're seeing in the East at the moment, it's going to get a hell of a lot more important. It is a loaded question, but that's kind of par for the course. When you're running an investment company, people always want to know what the right answer is, and people don't know what the right answer is. If I knew what the stock market was going to be doing now, we'd all be rich. We'd all make a lot of money. We don't. Yeah. But we have to. That's why we diversify our portfolios. That's why we invest for the long term. So I guess that's the loaded bit out of the way. Just to kind of repeat on what the ESG product is, it is our original portfolio is a whole of market product that looks at passive funds. So these are where people pick stocks, fund managers pick stocks, and then they kind of keep to those asset mixes. And
are those stocks that actually picked, or are they ETFs or ETF selections?
They're a selection of funds, and then we look at who is the best fund manager. We look at performance, net of costs through various different scenarios, and then we kind of link different funds with each other. So if some funds kind of correlate differently to others, so we try and put the package of funds together that get the best overall performance. But that's a passive selection. That's looking at funds that kind of select an asset strategy and some underlying stock, and then kind of track to that basically. And so what we're looking there is more how well the fund manager is performing. On the ethical side, we created our ethical portfolio because we want to make a difference to the world, and lots of more investors we're seeing also want that. About 2 years ago, we were selling about 1 in 5 of our products were our ethical products, and now we're looking at about 1 in 2, 1 in 3. So it's becoming massively more interesting for customers. We want it to flip around. We want to sell more ethical than we do original, because that's kind of the direction of the travel. The downside of ethical at the moment is it's just an immature market. It's an actively managed fund. So these are fund managers that will regularly review their underlying stocks and asset strategies. So they're doing a lot more work and therefore charge more, which is, as a result, it costs the underlying funds
a little bit
more than the passive funds. Our cost is the same. We links in with our simple proposition. Our cost is 60 bips no matter what, but the underlying funds for actively managed are more because they do more. And then we look for funds who exclude weapons, adult entertainment, gambling, and tobacco. There's lots of different ways you can kind of pick your question. The person who asked the question actually called it an ESG fund. You can call it ESG. There's sustainability. There's green. There's ethical. We picked ethical to be as simple as we possibly can. We put out there, these are our exclusion criteria. We're not going to greenwash. We're not going to try and market the crap out of it. These are the things that we're excluding. If to go to a sustainable, we would then need to probably take things like fossil fuels out. And the amount of funds in the market, once you've taken fossil fuels out, just isn't there to get the geographic coverage and to get the asset class coverage. Now it's getting better because it's a young market. There's more people entering in the market. So in time, we'll hopefully be able to move from ethical to sustainable, and that'd be a great step forward. But at the moment, we're kind of waiting for the market to catch up. It's a great little product. It's an award-winning product for that result. We're very clear on what we include and what we exclude. It's actively managed, and we get lots of great comments from our customers, lots of great questions actually from our customers who love our ethical product. Now, how important it is for the future? I don't know whether it's how it's going to perform in the next 3, 5, 10 years. In the next 3, 5, 10 months or so. Again, you have to look through the cycle. The ethical fund actually took a bit of a reduction at the start of the year, more so than our original portfolio, because it had such a really good run over the last 2 years from stocks in the US, such as the Facebooks, the Amazon, which met our exclusion criteria. But then as inflation started to hit at the start of the year, those stocks actually reduced in value because a lot of their returns, their dividends, are paid way into the future when they make more money. And so as interest rates rise, the value of those future earnings just drops as a simple mathematical value of cash flow calculation. The company's strategies and numbers didn't change that much, but when interest rates change, things in the future are worth less than they are now. So actually, when you're looking forward for ethical, what you need to think about is how much do you believe the earning potential of these kind of technology funds? There's a lot of technology funds kind of in there now because it's kind of the new wave after kind of oil and weaponry. And lots of other funds in there. Lots of green funds are coming up as well. But again, they're very new. And so what's the earning potential of those greener funds? Do you believe them? And then second is, what's your view on interest rates? So if once you believe that that's the cash flow profile, do you think that inflation is going to be really high? And so the value of the 20, 25-year cash flow is worth less to you now? Or do you think that the inflation is not going to be as high and then the value is a little bit more? So there's two offsetting factors, kind of current kind of topics that are weighing on those ESG funds at the moment. It's a massive push from the market. It's been great to see a consumer-driven. It's really been a consumer-driven push into sustainable and ethicalness, which is great. We do need to keep an eye on that greenwashing. But I think as you come out of the back of what's happening in Russia and the Ukraine, which is terrible. But if we can pick any good things from atrocities like that happening in the world, is that we're becoming less reliant on oil and fossil fuels. Hopefully, we'll move to greener funds quicker. And we see that as a bit of hopefully a bit of a winner from what are terrible events that are happening.
It's interesting the number that you quoted there in terms of like one of two now being ethical selection, because I remember even when I look back maybe 3 or 4 years ago when I was with a DFM, we talked about ethical and sustainable and all that kind of stuff, and it was kind of like we kind of know it's there, but nobody really wants to buy this, so we're not going to bother. And it's amazing to see how quickly over the last 3 to 4 years it's now become an actual thing, where it feels as though there is a demand, or at least an ask from the general public to say that we want to invest our money in these things that make the world better further down the line. We don't want to fund, armaments and tobacco and pornography and that kind of stuff. We want to be invested in more sustainable. So that's where, the likes of EV, Tesla and all that kind of stuff come into it. It's amazing to see that drive. Do you think we get to a point in the near future where the option will be ethical from customers?
I hope so. I'd love it if that was to happen. I mean, the option for ethical is there now. So I guess what your question was, that will it be their first choice
Yeah.
as ethical? We're trying as hard as we possibly can. I know lots of other companies around the globe are trying now to try and get it as kind of ethical as standards from an investment point of view. As I said earlier on, the fees are a little bit higher on the ethical piece at the moment. I don't personally see there's much point in ethical passive managed funds because you don't know what's in there and
Yeah.
people
Yeah.
ethical change. So you've got to kind of go
Yeah.
ethical active,
Yeah.
which cost a bit more. So you need more funds to come into those markets to make the funds cheaper,
Hmm.
and we're seeing that. But as you said, the push by the consumer, which is great, I love that. I know there was lots of negative stuff that came out of things like GameStop investments and things, but just the amount of passion and energy that came from consumers driving the stock markets, just that that's a big turn
Hmm.
of consumer power coming through, which is awesome to see, and that's that kind of power and energy is driving a change in ethical. But that power and energy has come in the last couple of years, and the funds that we invest in need to be of us, and not just ourselves, other fund managers need to have been around for a certain amount of time. As ours is 3 years, and needs so that we can manage people's see how people have performed
Hmm.
over time, and they need to have a certain amount of balances in them to be big enough so that you're not a big concentration risk for them, or that they're not a big concentration risk for you. So I think there's been a lot of ethical funds launched in the last couple of years. So we will definitely see a big push towards ethical in the push towards ethical in the coming couple of years as the funds start to get cheaper because the selection of funds we can invest in grows.
I think it's a really good point you made there about the fact that if you're going to go ethical, it kind of has to be active. And just for those of you who may not understand how this basically works, if you picture, you're invested in 50 or 20 companies in one go, and you want to invest ethically, well, what you don't want is company A that you're invested in having, I guess, maybe an investment on the side or dealings with a company that is against your ethical mandate. And so if you're in a passive, you have more chance of that happening. So an active solution basically means that you're constantly looking to make sure that there aren't any breaches of your mandate from an ethical point of view, which requires time and expertise, which is why it typically costs a little bit more for those kind of funds to actually be run. It does put a lot of. Do you find it puts people off the cost in
I, I,
feedback?
I think that's probably one of the bigger reasons why people aren't choosing ethical at the moment, because particularly if you're new to investing for the first time, you're
Mm,
coming from a bank account where you don't get charged fees. It kind of grates on you a little bit that you're getting charged fees on an annual
yeah, yeah.
basis. So you're thinking, all right, well, I want to minimize them. And then you go, right, okay, well, it's so our funds, for example, our original funds say cost 15 bips or 0.15%. Our ethicals are about zero point 0.6. That's a big difference, 0.6% compared to 0.15 and this is the underlying funds. This is not our charge. This is what the fund managers are charging you for their active management. Somebody who doesn't understand the difference between the two is going to go, well, I'll choose a cheaper one, please. It's just your
Mm.
natural
Yeah,
logical
yeah, yeah,
conclusion, isn't it?
yeah.
But again, as I said earlier on, you have to look at what you're paying for and what you're getting in return, just like you would do at the supermarket, or if you're going to buy a car, or if you're going to buy some clothes, you look at what the cost is and what you're getting for it. And we try and make it as clear as possible as we can for the difference between active and passive, between our ethical and original. But it comes back to the education point earlier on. Unless we're talking about it regularly, unless your aunts and your uncles and your neighbours know the difference, and you can have a chat with them over the fence or down at the pub around what they're investing in and why they're choosing this and what's the difference between the two. Until it becomes second nature to us, we're always going to kind of shy away from the extra bit of what could be considered risk and cost, and probably go
Hmm.
to the ethical one. So I think we need to do a lot more work on the education of the different costs and the different values you get from different propositions before people start swinging more to ethical.
Yeah, I think one of the big gripes with ethical historically has been, well, number one, it's more expensive,
Mm.
and traditionally the performance hasn't been that great historically. I think that's changed a little bit now in terms of the performance of maybe the last 3 years. Maybe they've done quite well in comparison to some of the non-ethical funds. It will be interesting to see how that actually continues. There was a comment here from Anna. Actually, I can actually get this up on the screen. She says she's got a junior ISA with you guys, with them, and it's only stocks and shares account I have that hasn't gone into negative during the crisis. Good job. So I think that's probably a kudos down to the investment team there, and this and
Yeah,
the
I mean
the
that's great,
operation.
and it's it is kudos to our investments team, but there'll be quite a few people on this call, and lots of our customers who are sat there with negative balances, because it's not been a great start to the year. You've had
Mhm.
inflation start in January, and then you had the Ukraine and Russia crisis in February. So
February, yeah,
I think if you as you've said, the last 2 or 3 years were good performances. If that's built up a good bit of green, a good bit of positive growth, it saved you from the first couple of months of this year. But I think anybody that has invested in our ethical portfolios from about June, October time would probably be in red territory now,
hmm
which is a shame. And particularly for new investors who are investing for the first time and they see it red, they go scared because they're used to that kind of balance guarantee. And we're
yeah,
putting out some great comms. My comms team are doing a great job at trying to get to reinforce the message that we're investing through the cycle. You've
hmm
invested with us to get a 3, 5, 10 year view, not a 2, 3 month view, because you can only crystallize that loss by taking that money out.
yeah,
That's guaranteed, and we try and remind people of that, and it's their decision at the end of the day. But you can't walk away from the fact that it's everybody has had an awful time for the start of this year, and the best thing we can do as market commentators is to remind people to look through the current turbulence and look at why they're investing, look at the underlying fundamentals of what they're trying to gain in the next 3, 5, 10 years, and have they changed? Has our growth and our inflation views changed for the next 5, 10 years because of what's happened over the last couple of months? We don't think so. We still believe that quite a lot of the inflation is transitory, but there's a lot of talk around it feeding through into pay inflation, and then it starts getting real, and then you'll have to look at
yeah,
how does that compare to growth. So there's
yeah.
lots of things that kind of feed into that, whether it be ethical or original. But you have to look through. You have to look through the current turbulence and to kind of your investment horizon.
Yeah, I think it's really You've just echoed something I always say there in the fact that unfortunately there have been a lot of first time investors come into the markets over the last 24 months or so, and this time right now is going to be very very difficult. I mean, I
Mm,
get messages all the time where it's kind of like I'm in red, and it's almost as though there wasn't the expectation that the markets could turn on a
yeah,
dime as quick as they did because of the combination of inflation and Russia. And I think that maybe again that goes back to the whole education bit
yeah,
around this is really what investing is all about. It is you're trying to take a chance on the markets over the long term. We know that markets typically return great over the long term, but in the meantime, in between, you're going to have periods of growth and you're going to have periods of decline. And I think that message is really, really important in coming through and comms, like you're saying, just communicating with people to say, look, this is what's going on, this is what we're doing, this is the way we view things. I think that's really, really crucial to give people peace of mind.
yeah. I completely agree. Completely agree.
Yeah. There was a question on here. Yes, so there is a question on here from Jennifer. Um, I'm a novice to reinvesting. Can I invest in gold via Wealthify?
Short answer is no. So we look at a range of different stocks. We have a diversified portfolio, so you can't. It's not a self-selection fund. You can't select which funds you invest in. You can't invest in gold. You can't invest in a US fund only, or you can't invest in a certain company only. There are funds on the market if you just want to invest in gold that you can get direct access to that. But Wealthify, it's a diversified portfolio.
Yeah, and Jennifer, just adding on to that, I think one of the key things to remember is that when you're looking to invest, there are two ways. We spoke about this a little bit earlier on. You can do the DIY stuff, which is where you get to self-select. So you could say, for example, you want to go and buy a gold ETF, and I've got a couple of videos on those kind of things, and you can go and buy those specifically. But you're doing that under a self-select kind of like mandate. So you're taking charge, you're doing the research, you're picking the one that you want to go and invest in, and therefore you then manage it from there on out. With Wealthify, because they're quote a robo advisor, what you're essentially asking them to do is you're asking to put money with them, and they will go out and research where they feel they're going to be able to get the best returns on your behalf, and they do all of the management. So it's not a self-selective, if you will, where you can go and invest in gold specifically. I mean, gold right now, I haven't. The last time I checked gold, obviously it was doing really, really well. And gold typically does well in times of conflict. So as a diversifier, it's a good thing, I guess. But you have to obviously understand how you're going to access the gold, because that in itself can be a little bit of a minefield. Do you buy physical? Do you buy ETFs? You can get, gold back, physical gold back ETFs. You can get all kinds. It's just understanding how you're actually going to go about doing all of that as well. I mean, on the cost of living kind of side to things, I think there will be a lot of people who will be more tempted to invest in the markets now because of the cost of living crisis. What's your take on that at the moment?
I think it's going to be mixed. I mean, hopefully it spurs more people to think about inflation and what I call the kind of the stealth tax of inflation, that if it's in a savings account, you're going to be losing money each year from the amount of inflation's eating away at it. So the more education we can do to kind of help people understand that, and kind of building your future wealth whilst your disposable income is being squeezed is an important factor. You're kind of looking for the future because you know the current market's being squeezed. But that, I also am aware that quite a few people, can be a bit of a pipe dream. People have kind of sat there going, I can't afford to pay my fuel right now because this has doubled. Never mind save. Yeah. Which kind of comes back to the point I said earlier on. You need to make sure that you've got kind of 3 to 6 months rainy day fund. That you make sure you don't have credit cards outstanding with lots of high interest fees and things like that. We do a suitability questionnaire when you're joining Wealthify, as do all the robos, to make sure that investments are the right thing for you. And that will include things like this. So I think it's a dual. I think there's two things coming out of it. One should be spurring more people on to invest, but then for others, it will mean that they have less to invest and therefore probably won't.
Yeah. I mean, I think the biggest fear that I have, and I kind of get this in some of the comments and questions that I've got at the moment, is because I think people do understand that there is something called inflation, which means that your money's not going to go as far. And maybe this is just a symptom of social media and the fact that there's a lot of misinformation out there. They then look at investing as a way for them to compensate for potential income, generating a passive income in the short term. And I'm always like, you're looking at it the wrong way.
Yeah, completely.
Particularly if you haven't got large sums of cash that you can put in one go to potentially be invested for as an income mandate. And I think there's a little bit of a danger there because of some of the information that's out there on social media. I took a call the other day, which was along that vein. It was like, I want to invest. I know that obviously energy prices are increasing. I want to invest some money to compensate for that. It's like, well, probably the one way of looking at it, mate. But there you go.
Well, I think that kind of brings out a big question around trading versus investments. Those people that want to put 100 quid away now to try and turn it to 250 to pay next month's gas bill, they've got a very short investment horizon of 1 month or 3 months or whatever it is, and they want big swings as a return. They want it to go up 50% in that period. That's not investing, that's trading. And you need to know what you're doing when you're trading. There's lots of people lose a lot of money on trading, and you might get lucky and you might not. And following, even if you follow social media themes, you need to know what you're investing in. It's your cash, it's not theirs that you're investing in. So you do need to be careful with trading. We don't trade. That's why I've kind of said lots of times throughout this call, you need to be looking at 3, 5, 10-year investment horizon, because that's where we manage your funds for you. We're looking at those types of return horizons when we're deciding on our investment strategy, not 3 months to pay your gas bill.
Yeah. There is a question here from Spencer, which kind of leads into what you kind of said there about trading. It goes, is Wealthify cheaper than FreeTrade? And do Wealthify lend out the funds like FreeTrade are and going to start doing so? I can answer that, but I'll let you answer it as well, Andy.
So Wealthify are not cheaper than FreeTrade because, as the name suggests, they are free. So FreeTrade make their money by, instead of taking a percentage of your funds, they take their money on what's called the bid offer spread. So when you transact, they take a little bit off that. So it's a little less transparent around how they take their money. But again, that's a different proposition to Wealthify. It's not comparing apples with apples. FreeTrade is a self-selection fund. You're looking at which trades you're going to invest. You're probably making trades regularly. FreeTrades take their money on when you make trades. So it kind of works for that proposition. Our proposition isn't that. We're not a self-selection tool. We're not a trading app or trading platform. We set a long-term diversified investment portfolio, and then we manage for that for you in the long term. And so the best way to, if you think about the two different customer journeys, FreeTrader for people who are looking at how to trade regularly, and they take their money from when you trade. We're looking at investing and managing people's income for the investments for the long term, and we take our money off your funds for the longer term. So I think the kind of business models kind of work for each of the respective products, but they are different products. And I think it's really important. I've said it a couple of times, and I apologize if I keep repeating it, but like you go to the shops, if you go to the supermarket or buying clothes, you look at what you're paying and you're looking at what you're buying, and you have to do that with financial service products. You have to look what it is that you're buying, what's the product that you're buying, and the price you're getting it for. And FreeTrade is a different proposition to Wealthify. So the second point is, do I lend out funds like FreeTrade? No, we don't. I know some of the US robos do. We may look at that in the future. It's certainly not on our propositional development road log for the next couple of years, because we're a lot younger the company than some of the robos in the US than FreeTrade, and we're in that cycle of kind of iteratively improving. We're doubling about every 6 to 9 months in customers at the moment, which is great, and we're getting some great feedback. But that's our development cycle at the moment. We're selling to more people. We're getting some great feedback for them. They leave us some awesome reviews on Trustpilot. We've got a market-leading Trustpilot score. But they give us some great information about our product, and then we build it and iterate it to keep it brilliant. So we're kind of in that circle at the moment. And once we've perfected our product, then we can look at some other cool things like lending out on your funds.
So this is a question I have for you, because one of the things that so the latter part to this is the fact that within FreeTrade, they recently changed their terms and conditions, where if you had let's just say you had 10 shares of Tesla, what they're basically doing is that they can actually lend out your shares and essentially use that within the trading pool, I guess, is what they're planning on actually doing there.
Right.
That model wouldn't work for what you're doing within the way you build your funds, though, would it?
No, I took that as something else. So what some of the guys in the US do is, if you're invested for the long term in your diversified investment portfolio, and you need some cash, but you don't want to pull out your investment,
Oh, right, yeah.
You can lend. They set up a lending portfolio so that you can you don't have to disrupt that investment strategy. That's the question I was answering. The lending your stocks is a completely different profile. That's what the investment managers do in the city. And I wasn't aware FreeTrade were going to do that. Actually, we should have a look. I'll have a look at what they're doing. That's quite complex and leveraged risk return profiles. You're lending out your stocks to someone else and getting a return on them. That's again, you need to understand what product you're getting, what risks you're taking, and what returns you're getting in return. But we don't do that at Wealthify now.
Yeah, it will be interesting to see when and if you do actually develop that lending portfolio. And what I mean by that, guys, is, so imagine you had, like, I don't know, £10,000 invested, right? And all of a sudden you're like, okay, I need £2,000, and you have your investment portfolio in there. Imagine how great it would be if you could say, actually, you know what? I'd like to borrow back some of that £2,000 from my investment portfolio. That's a pretty good. It's not that common, actually, in the industry right now. I know that I did work for a provider a while back who did that, but it's not a common facility. So it would be very, very interesting if you did develop that and make that available. I think that would help with people's financial planning long term, particularly as things happen and events arise during their lifetimes.
Yeah, I agree. Well, I think it's Wealthsimple in the US. I'm sure Betterment, I think, have got a similar product. So, but they're like tens of billions of pounds in size as well. They are 10 years ahead of the UK robo industry. So, you know, I'm very confident that time will come in the UK, but everybody in the industry is just at too young a stage to start developing those things at the moment, I would suspect.
There is a question here from Food Dweller. Do you have plans to introduce ETF passive funds on Wealthify platform? Well, some of the things that you do at the moment, it's passive funds generally, isn't it?
It's passive funds. We're largely mutual funds at the moment. We can invest in ETFs, and I guess they're constantly in our investment challenges. Which ones do we use and which ones we don't? So we answer is yes.
Okay. And he's also asked you in a follow up, do you have a LISA, lifetime ISA product at the minute?
No, not yet. I want one. You know, if you think about what our proposition is, trying to help people build for their future wealth, LISA is awesome. You know, the tax rebate you get, the other thing we've not really talked about investing as well is the purpose. Why is it you're investing? What's the tangible thing you're going to get out of the back of it? And LISA is awesome for that because, you know, most people are investing. Oh, not most people. There's a lot of people investing to try and save up to buy a house. Lots of the young people invest to buy a house. That's exactly what a LISA is set up for. So it's something that we've very much got our eyes set on. It's certainly not something that's going to be developed by us in the next 3 to 6 months, but you know, it's one of my that I keep annoying my dev guys about. We will be spending some time on developing that or looking at how we develop that in the coming months. But we're a young company and we have to prioritize what we can build and when to try and keep our costs low, so we can keep being the lowest cost provider in the market.
Yeah. One of the great things about lifetime ISAs that I've discovered is because obviously primarily for younger people or people looking to get on the poverty ladder, it's that mechanism to get a little bit of help from the government and it accumulates and it gives them a very nice like target. Like my deposit is this. If I can work towards getting this into a lifetime ISA, I'm going to get this bonus from the government.
Yeah.
But as a side kind of effect to that, it's been really, really good in opening their eyes to actually, I could use this for retirement funding. Then the whole conversation around pensions then come into it as well. And I've always seen it as a very nice segue into that retirement piece and that conversation around pensions.
Yeah, exactly, and that's why it fits so well into our purpose. So it's definitely something we're going to be looking at. There's the downside risk that, you know, if you're trying to buy a house in Manchester, then that house price inflation might differ from the investment fund you've got into, and they might go at different build at different rates and grow at different rates. So you have to be aware that the thing that you've got your eye on might change in price at a different rate to the thing that you're saving. But that aside, it's a great product, and as you say, it gets people into saving who probably haven't saved before. If you're asking your dad or your auntie or your neighbour about how you save for a house, they'll probably put it in a bank or a savings account because that's what we've historically done in the UK. So actually getting people to try to save in stocks and shares for the first time by giving them that bit of a tax kicker from the government is great. And I think, you know, I applaud it. And very much jealous we don't have one at the moment. I'm very much I'm a bit of a grumpy CEO with a kind of bee in his bonnet about how soon we can get one.
Yeah, there is a question here. What is the initial amount to invest on Wealthify platform, and what's the minimum? I think we've already covered the minimum being £1, but do you have initial amounts?
No, they're both the same amount. It's as little as £1. You can set up from as little as £1 with us. I think the pensions are minimum £50, so it's a little bit more for the pensions. But yeah, as little as £1. There's no initial amount. You know, it's the same thing. If you've got £1, you can invest with us.
Cool. And To Wallace here has actually just asked a question, which is actually quite interesting. Why wouldn't someone just invest in BlackRock or Bridgewater?
Well, that comes back to our point earlier on around stock selection, self-investments, versus managed for you solution. If you know which funds you want to invest in and which geographies and which asset classes, and you can get them from BlackRock or Bridgewater or Vanguard or, you know, one of the other low-cost providers, then great. That's the right product for you. I've said throughout all of this, look at what product you want to buy and then the cost of that. That's not our product. If you want to self-select, there's some really good cheap products out there. but then you should regularly monitor it, and you should regularly take views on your own asset allocation, and you should change them based on what your views are. If you don't have the time or the experience or the confidence, there's some great money out by Holly at Borrowing Money that something like 6 out of 10 people don't have the confidence to self-select. So if you're one of those 60% of the people in the UK that just doesn't have the confidence to self-select, they don't know whether to go in BlackRock, Bridgewater, or Vanguard, or whoever. If you don't have that experience or confidence, then you need somebody to manage that for you, to manage the investment strategy, to manage the diversification, to manage which funds to select in, and then to regularly review the market and keep all those things up to date.
Yeah, I would definitely echo that. I mean, there is clearly a huge swathe of people who are investing right now who do actually want to take control, who do want to have, that self-select option. And I think a lot of news and a lot of, GameStop has been a big catalyst towards that. Like, you can invest in these companies and they can do really, really well. But I think when it comes down to the actual reality of, especially in periods like where now the markets are quite volatile, unfortunately, you don't know what you don't know until you don't know it.
Yeah,
So
I agree.
sometimes people feel as though I can do this, but then you get to it and it's kind of like, I'm not really too sure. And I always say to people that, cost is always something that you should have in the back of your mind as something that you have to tick off and make sure you're okay with. But I always ask the question of, if you were investing and this money is going to be for a house deposit or whatever it might be, can you afford to get it wrong?
Yeah.
If you get it wrong big.
Yep.
Now, it isn't to say that, using someone like Wealthify or anyone else would guarantee you success, but at least you know that you've got a team of experienced individuals trying to steer the ship for you, if you will.
Yeah. The big word in there is diversification, isn't it?
Mm-hmm.
So we've got a team of experts who are selecting an investment strategy that is diversified across the globe. If you're, and it kind of comes back to the question you mentioned earlier on around people trying to trade to kind of pay their fuel bills. If you're trying to get that quick return and not covering a diversified portfolio, if you're just going in GameStop or you're just going in oil or gold, as we mentioned earlier on, and you're just going full into that, you kind of you have to be confident, or you have to be happy to be able to, well, particularly on GameStop, you lose your shirt. If you're happy, if you're playing with money you don't mind losing, then you can trade. But if you've got a reason for in that investment, and you need that certain amount in a certain point in time, then you need to take that into consideration when you're choosing how and where to invest. And if it's in the long term, you should be investing rather than trading.
Absolutely, 100%. There is one question. Oh, Naeem is actually here. So Naeem's just jumped on with this one. Would people be eligible for the prize draw if they opened your account last year, or is it applicable only to new customers? I think what he's asking here is the £20,000 prize draw, which is got the entry date 1st of June, excludes Northern Ireland. I think he's already got an account from last year. Would he qualify or be entered into the prize draw if he opened, say, like a general investment account, for example?
So I need to check the terms and conditions this year, but I'm pretty sure we signed them off exactly the same as last year, which was you just have to enter it. It's open to new customers and existing customers.
Okay.
We didn't want to be the kind of company that only offer these great options and chances to win out of new people who've never invested before. We want to entice them in. We want people to come and use our great service, but we also want to reward the people that's been with us since the year dot.
Mm-hmm.
If you've got an existing product with us, you still need to enter. You don't automatically get entered, but you should be able to enter.
Okay. What we'll probably do is maybe provide some links and stuff like that for you, Naeem, so that you can check that out. I think the prize draw is really, really great, by the way. And I know you've also got the cashback offer as well, where people, if they're transferring an ISA or a pension, they can get up to £200 if it's an ISA, £200 if it's a pension that they're transferring, or if they're doing both, up to £400. I think that's really, really cool. But that prize draw, that £20,000 prize draw, I think is a really, really great thing, because I think I automatically think ISA allowance. That's already an assignment to that. Pretty much, that's money that goes in. So yeah,
Yeah, and well, listening to we've got the commentary from the call, the kind of voice recording from the call last year, and just listening to that call is awesome. It's one of the nicest memories I had from last year is listening to that call. Actually, the guy that won it was just so overwhelmed and pleased, and I think our customer care lead Sarah was as well. It was great to give away. It's great to be able to give that to somebody, and if we can use that to kind of waken other people up to invest in, then brilliant.
yeah. I wonder what he did with it, whether it stayed invested or whether it went towards. Because people will look at that and be like, "Oh, actually, I could pay off part of my mortgage. I could."
Yeah, yeah.
You get into the conversation of should I pay off mortgage or should I be invested in the stock market? It's like, well, what's going to make you sleep better at night?
Well,
That
too
is
right,
the real
too
big
right.
question. So,
But what a great problem to have.
indeed, indeed, indeed. All right, okay. So we've been on for about an hour and stuff on here. Lots of questions on here. I might kick on for another 20 minutes or so because I know that there are some questions on here around sort of energy stocks and stuff. Best ETFs for energy stocks. Um, I haven't addressed energy specifically, or have I done energy? I haven't done energy stock specifically. And I think this is a very, very interesting conversation and question because I'm guessing people are thinking, well, if energy prices are going up and we're being forced to up those direct debits to the levels that they're enforcing at the moment with the the tariff changes, on the other side, whilst it's going to cost you more money as a consumer, potentially with interest, profits and stuff, there might be a good investment opportunity there. But I don't think I've covered that in a video just yet. So I can have a look at maybe just having a conversation on a video about that specifically. But I don't know of any energy ETFs specifically without actually having a look at it. So I can actually say, look, this is what it does, pros and cons, so on and so forth, so that you guys can at least make an informed decision on that. So I might have to look at that a bit later on for you. Yeah, I think that's it, really. I know Kev has just puts on here. He goes, I've done absolutely terribly. Well, let's have a look at this quickly. This is always interesting. I've done absolutely terrible buying individual stocks, bought too high, bought overvalued stocks, don't know when to sell and take profits and diversify. Never lost so much so quick. Mate, I feel your pain. I do. I really, really do feel your pain. And this is a very, very difficult one because it's like, I know what it's like when you're looking at it thinking, okay, I'm in the red by quite a significant amount and not knowing really what to do. And typically, the old saying of it's not a loss until you've literally crystallized it. It's only a loss in paper right now. That stands true right here. And I always say to people that, going into it, has anything changed in terms of your goals? How long were you looking to invest for in the first place? If it's 5 years, 6 years, 7 years you're looking to invest for, this doesn't really matter. It's kind of like it's a blip in the road. It's like a little bump in the road. You're going to be okay. It will recover. It might just take a little bit of time to recover. But I know how difficult it is facing that kind of situation where you've gone into individual stocks and then all of a sudden, you've lost quite a bit of money on the what it feels like a turn of a dime. And again, this is where knowing how you want to invest and the pros and cons of how you're going to invest become really, really important. There's a lot of hype uh, content on YouTube. I mean, in my magazine this month, I used the example of Nikola and this is one, Andy. I don't know whether you have followed this, right? But Nikola was this rival to Tesla. They were going to produce like electric trucks, and they had videos of this truck fully operational. And at the height, I think the share price was something like $70 a share in June 2020. As it turned out, the actual truck that they had commercials of running was actually rolled down a hill, but inverted to make it look like it was going up a hill. There's a massive fraud case against the guy who was the helm of the business right now.
Yeah.
$70 a share in June 2020. There were lots and lots of videos on YouTube talking about this is the next Tesla. You should be piling in all that kind of stuff. The share price right now is £9, $9.66. It's massive, massive loss. And when you think about, phrases like buy the dip, that phrase would have been used for that company. And again, it's one of the situations of maybe not really understanding fully the way the land lies when you're buying individual stocks because you're taking that higher level of risk and diversification matters. to make sure that you're able to mute that risk down a little bit.
It kind of links back I'm sure I'm boring people with the analogy of buying clothes or food in a supermarket. You need to know what you're invested in, and Kev, if you knew what you're invested in and it just didn't work, then you need to balance the rough with the smooth, and sometimes it'll work and sometimes it won't. If you're listening to other people investments advice or you don't quite have the experience or knowledge to invest, then you kind of need to look at whether you've got the right product or not. Whilst like memes, stocks, and social media advice sounds cool, it's your cash at the end of the day. It's not their cash. Yeah. You need to understand what you're doing with your cash. Are you happy with putting it in this company? Have you done the research? What are they doing? What's their future profits? What's their company profits look like? What's their governance structures look like? If you're looking in investing into funds, what companies do they invest in? What work do they do for that money? So you should always look, just like you would a loaf of bread or a piece of clothing from Next. Look at what you're buying, and then look at how much it's costing you.
Yeah, and I can't echo that enough. And yeah, I mean, Kevin just said here, if I had my money back, I would definitely invest into managed funds. And this is, especially if you're new, like a lesson like this is quite painful and hard to take, but you can chalk it down to experience, because now I mean, even with all of my experience in the industry, I still have money invested in managed funds and portfolios, and I still have my individual exposures as well, because although I know a lot, I don't profess to know everything, and there will be things that I will get wrong. And I'd rather entrust it to somebody else to go and do on my behalf than have all of the burden and all of the weight on my shoulders. I definitely don't want to be looking at, investment charts and then looking at my portfolio when, I could be clouded with the bad news of, what's happening to the world. You have to be able to make very clear decisions when it comes to those kind of things. And it can be very, very difficult when you're managing your own money because of that emotive connection that you naturally have to your own cash. That's just the reality of it. It can be very, very difficult to make a sound decision based on what is right from a factual point of view. Whereas if you have it outsourced, these people are going to be looking at it from a dispassionate point of view. And that can be an advantage because guess what? They don't have the emotive and emotional connection to your money. So they're looking at hard facts saying, right, where should we go? What's the best solution? What should we do? Where do we think this is going to be best place for the best return over a period of time, considering all of the risk and the diversification tactics that we're going to employ? That is an advantage. The downside that most people see in having that kind of service is the fact that they've got to pay a little bit extra in fees. Now, I can't get around that argument for everybody because, it's your money at the end of the day. You've got to make the right decision. But it's almost like the reason why you would go and buy a BMW versus buying something, I don't know, like a Fiat Punto, right? People who go and buy BMWs like the quality of a BMW and they pay the extra premium for that. The same thing applies in the investing world and in the finance world as a whole, I guess. Would you agree with that? What would be your final words, Andy?
Yeah, I guess I completely echo that. I guess my analogy is kind of like buying a bike. If you're a bike fanatic and you can source your individual bike parts from lots of different places and you get really excited about what kind of saddle to buy or what the gear change sets are and how they all link together, crack on, go and self buy your own individual parts and put it together. If you don't have the knowledge or time to do that, you go and buy a bike from a shop.
Yeah.
And that and financial service products aren't any different to normal products. If you know what you're doing, you can get it cheaper and cheaper elsewhere. If you don't know what you're doing, or you haven't got time to do it, or you don't have the confidence to do it, then perhaps you need to look at a managed for you solution.
Absolutely. This is a really good message and comment here from Pete, getting really positive vibes from Andrew.
Oh, thanks,
I think
Pete.
that's good, mate. That's really, really good. And I think,
that's a nice message to get on a Sunday night, isn't
it? It is indeed.
Thanks, Pete.
And this is what I think these kind of conversations are really, really important. Obviously, Wealthify are backing this channel and supporting this channel over the next few months. The important thing here is not necessarily to have you go and buy Wealthify. It's education. And this is the thing that Wealthify and I really, really do hold closely and we align on 100%. This is all about education, actually helping people.
Yeah.
You guys are adults. You don't need to be babysat. We're not your dads, your uncle, your aunt. We're not of anybody of influence who you should be listening to without any other kind of uh, resources or influence in terms of questioning whether what you're hearing here is the right thing. The point here is to have conversations that hopefully you take something from, and you can add that into your arsenal when you're making decisions about what you want to do with your money. It's not to try and shoehorn you into something because, by the way, this is what I'm talking about, and these are the people that are supporting me. It's about giving you context, giving you content, food for thought that will hopefully inspire and inform your decisions moving forward. That's the most important thing. And whilst you're at it, if you do invest with them, you can enter into the prize draw potentially for £20,000. That's an added bonus. If you get the call, you get the call. If you do get the call, though, you've got to give me a call right afterwards as well, because I would love to know if it is someone here who actually or someone who follows me who actually wins the £20,000 in the end. But who knows? Chances are there. But
Yeah.
Andy, I really do appreciate you being here on a
No,
Sunday evening.
thanks for having me, Pete.
Thank you so much. And guys, thank you so much as always for being here. You always do support the channel. I do have a couple of surprises coming down the line in maybe 2-3 weeks time. I have a behind the scenes. I might have 2 behind the scenes videos for the filming for Channel 4. So you'll get to see a little bit of the process and what it's like. It's been an absolute blast. It really, really has. So I'll show you a little bit behind the scenes of that later on. I'm just waiting for the date of when it's actually going to air so we can put that into the edit. So it will come out maybe a week or maybe 3 or 4 days beforehand, but that'll be a little bit of bonus content for you as well. But I appreciate you. Have a good evening this Sunday. Have an amazing week. The podcast will be live 6 a.m. tomorrow morning as well. Catch you in a bit. Cheers, guys. Thank you.
Thanks, everybody. Bye.